Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know First Bank of England's split rate decision signals a dovish hold, hinting at a policy pivot from the Fed that could shake currency markets. We'll analyse why this internal division matters now and how it could affect the pound to dollar exchange rate and global investor strategy. Second, Disney pulls Jimmy Kimmel Live after Trump's license threats, exposing a high-stakes play by Nexstar to secure a $6.2 billion merger. We'll explore how this weaponization of regulatory power could reshape risk for investors and set a chilling precedent for other regulated industries. Third, 475 workers arrested at Hyundai's Georgia battery plant, revealing a critical labour bottleneck that could derail US industrial policy and boost China. So we'll discuss why the company is cutting profit forecasts despite higher revenue and what this margin compression means for the auto industry. The Bank of England just held interest rates steady at 4%, but the real story isn't the decision, it's the division. Inside the bank's rate-setting committee, split vote saw 2 of the 9 members push to cut rates immediately, revealing a fracture in the consensus on how to steer the UK economy. A while back, we highlighted how the UK had become an inflation outlier in Europe and how that put policymakers in a bind. Today's split is the clearest sign yet that views inside the bank are diverging on how to navigate that bind. Believe it or not, this split decision, combined with other moves we'll get to in a moment, signals what analysts are calling a dovish hold. And that's significant because it suggests a potential policy divergence from the US Federal Reserve's more aggressive, higher for longer stance on interest rates. We previously contrasted the Fed's tightrope with Britain's more homemade inflation pressures, and the latest development is that this divergence may now become more visible. The takeaway seems to be that the UK might be signalling it has reached its peak for interest rates ahead of the US. For our listeners watching global markets, this could create new dynamics in the pound to dollar exchange rate. And it could also affect the relative performance of UK and US government bonds. The source of this tension is stubborn inflation, still running at nearly double the bank's 2% target. Governor Andrew Bailey issued a stark warning stating, "We're not out of the woods yet," adding that the timing and scale of any future cuts are now more uncertain. Continuing our last discussion that services inflation has been the single biggest driver, that's the piece still keeping the committee cautious. And as we noted before, some of these cost pressures are being passed through from domestic policy changes like high minimum wages and national insurance contributions. Now, when you have high inflation combined with weak economic growth, economists start to worry about something called stagflation. This is a toxic mix of a stagnant economy and persistent inflation, a scenario that haunted many developed countries in the 1970s, as we said a while back. It's like one foot on the accelerator and the other on the brake. The UK's current situation with sticky inflation and a very cautious central bank is being watched closely. If the UK struggles to solve this puzzle, it could serve as a cautionary tale for other major economies, including the US and the Eurozone, potentially shifting how global investors view risk. But that's not the whole picture. The bank also just made a major pivot on its massive balance sheet. After accumulating a staggering £875 billion in government bonds, it's now slamming the brakes on its sell-off. That shift fits the pattern we've been tracking. The bank trying to contain inflation without destabilising already sensitive markets. You know, the process of accumulating those bonds was called quantitative easing, or QE, where the central bank essentially prints money to buy bonds and inject liquidity into the economy. The sell-off is the reverse, known as quantitative tightening, or QT. It's a way to pull money out of the system to help fight inflation. The pace of this quantitative tightening will be cut from £100 billion a year down to $70 billion, a move explicitly designed to minimise shocks to fragile market conditions. Now, get this. This isn't just a minor technical adjustment. This slowdown is a preemptive move. It signals that the Bank of England perceives a real fragility in the market for UK government debt. By slowing down its bond sales, it's trying to avoid causing instability, which could limit the new government's ability to borrow and spend. This high-level manoeuvring is being driven by pain on the ground. While overall inflation is 3.8%, food and non-alcoholic drink costs are surging at 5.1%, led by staples like beef, butter, milk, and chocolate. A while back, we noted the World Bank's point that global food commodities, even after easing, remain nearly 40% above pre-pandemic levels, pressure that hits import-dependent countries like the UK hardest. That's showing up now in items like chocolate, where earlier supply issues in cocoa from Ghana filtered straight through to British shelves. It's a fascinating situation because while we see prices for many manufactured goods coming down, the cost of food and services in the UK remains stubbornly high. As we've discussed, that two-speed pattern with services running hot has been central to why the bank finds it hard to cut. This specific inflation mix is a uniquely British problem right now, and it could force the Bank of England to keep interest rates higher for longer than its peers, increasing the risk of a deeper economic slowdown, even if today's decision hints at a peak. Businesses told the bank they are passing on higher labour and food costs, while consumer spending on things like hotels and tourism remains subdued. That lines up with what we flagged earlier. Firms are still passing through cost push pressures from wage hikes and national insurance changes. Interestingly enough, the picture of the UK consumer is not uniform. Recent data from the GfK Consumer Confidence Index shows that while people are still very pessimistic about the overall economy, their view of their personal financial situation has actually improved slightly. This leads to what's called a bifurcated consumer, where people cut back on general spending but are still willing to spend on specific high-demand events like concerts. This uneven spending pattern makes it much harder for the Bank of England to manage the economy with broad tools like interest rates, and it echoes that two-speed inflation story we've been tracking. The takeaway is clear. The Bank of England is now fighting a war on two fronts. It is battling persistent inflation driven by everyday costs while simultaneously trying to prevent its own policies from destabilising the market. This signals that the UK's path through this period of economic uncertainty is far from over. So where do we go from here? The key focal point will be the UK's upcoming inflation reports, especially for food and services, to see if these stubborn pressures begin to ease. A few days ago, we compared the UK with Germany and France. Watch whether that gap narrows and whether services, the biggest contributor, finally cools. Also, keep an eye on the policy announcements from both the Bank of England and the US Federal Reserve. Any further divergence in their strategies will likely have a direct impact on the pound-to-dollar exchange rate and could shift global investment flows. This will show us whether the UK can avoid a deep recession or if it's truly becoming a bellwether for stagflation in the developed world. Disclaimer, this content is for informational purposes only and does not constitute financial advice. Market conditions are volatile and subject to change. Speaking of government actions creating turbulence for major corporations, the story in the US media landscape is getting even more dramatic. The most unexpected news in the media world today has to be this. Disney just pulled its own blockbuster show, Jimmy Kimmel Live, from its broadcast network ABC. This wasn't a ratings decision. It was a reaction to a direct threat from the highest levels of government. The market is already reacting, and here's where it gets interesting. There's something analysts call the media regulatory risk premium. It's a fancy term, but the idea is simple. Investors get nervous about these political threats, so they start valuing traditional media stocks like Disney or Nexstar lower than the rest of the market. For instance, the price-to-earnings ratios for these companies have been consistently trailing the S&P 500 average for the past year. This isn't just abstract fear. It's a real financial discount being applied to these companies, putting immense pressure on them to find new strategies to survive, and fast. Following comments made on the show, President Donald Trump suggested his administration should revoke the licenses of broadcast TV stations he said are against him. His direct quote, "I would think maybe their license should be taken away." Backing this up is the Federal Communications Commission Chair, Brendan Carr, who called the show's content an attempt to directly mislead the American public. Carr then issued a chilling ultimatum to all broadcasters. In his words, if you're going to have a license to be a broadcaster, it comes with something called you have to serve the public interest. If you don't want to do that, that's okay. You're free to turn your license in and you can go podcast. Now, the thing is, this public interest standard is the legal bedrock of the FCC's power, originating from the Communications Act of 1934. Historically, the FCC has used this power to deny license renewals. For example, back in 1931, a court upheld the FCC's decision to deny a license to a station whose programming was deemed not to be in the public interest. The implication here is that using this standard to explicitly target political speech sets a new and chilling precedent. It suggests a regulatory body can be weaponized against political opponents, creating uncertainty far beyond just the media industry. But this isn't just a political firestorm. The rabbit hole goes deeper, and it leads straight to a massive industry power play. Before Disney even acted, major local station owners like Nexstar and Sinclair announced they were preemptively dropping the show. This preemptive move isn't just about avoiding a political headache. Actually, it's a calculated business signal. This action is seen by industry watchers as a leading indicator of a strategic play to secure regulatory favours. Think of it as a quid pro quo in the making. So the thing is, Nexstar is currently seeking government approval for a massive $6.2 billion merger with Tegna, a deal that would upend long-standing ownership rules. Sinclair has also said it's looking to merge. These companies are bleeding subscribers in the streaming era and see consolidation as their lifeline. To truly understand why they're so desperate for these mergers, we need to look at their business model. For years, these local stations made a fortune from what are called retransmission consent fees, basically payments from cable companies to carry their channel. But as we all cut the cord and move to streaming, that revenue stream is drying up. This is a lagging indicator showing the broadcast model is becoming obsolete. Even Disney's own reports show declining affiliate revenue due to fewer subscribers. This is why consolidation isn't just an opportunity. For these companies, it feels like the only path to survival, and the same FCC chair threatening licenses has also publicly said he supports getting rid of the very ownership caps that are blocking these mega deals. The fight over a late night show has now exposed a high stakes game where political pressure and the future of broadcast licenses are directly intertwined with a multi-billion-dollar push to consolidate the American media landscape. The most immediate thing to watch is the FCC's decision on the 39% national ownership cap, which currently limits how many households one company can reach. If the FCC relaxes or eliminates it, expect a wave of merger announcements to follow, fundamentally reshaping the local news landscape. But the bigger shockwave is the precedent being set. If the public interest standard for a broadcast license can be used to pressure political speech, what about the federal licenses required to operate in other industries, like energy or banking? This could chill corporate investment and speech across the board as companies fear similar politically motivated retribution. This story started with a late night comedy show, but it has exposed a fault line that runs through the entire US economy. That idea of political risk hitting corporations where they least expect it is playing out in a huge way for the auto industry. In what's being called the largest single site enforcement operation in the history of the US, Department of Homeland Security federal agents just arrested 475 workers at a massive Hyundai facility in Georgia. This is where the situation takes a more complex turn. The incident may be a symptom of a much larger problem. After all, the US is facing a severe skilled labour shortage, especially for large-scale industrial projects. Recent data from the Job Openings and Labour Turnover Survey, or JOLTS, shows that the construction sector has hundreds of thousands of unfilled jobs. The situation is even more acute in Georgia, where the job opening rate for construction is significantly higher than the national average. That's a critical detail because it suggests that the boom in US manufacturing, driven by new policies, could be hitting a major bottleneck, a lack of skilled workers. This isn't just a Hyundai issue. Even TSMC faced delays building its Arizona plant due to similar labour sourcing difficulties. This crisis is unfolding just as the automaker kicks off its first ever investor day outside of South Korea, a major event led by its brand new CEO, Jose Munoz. The raid targeted a $4.3 billion joint battery plant with LG Energy Solution, where more than 300 of the arrested workers were South Korean nationals detained over suspicions of unlawful visas. The situation escalated to the point where a chartered plane was used to send many of the workers back home following discussions between US and South Korean officials. This raid is also a critical stress test for America's friendshoring strategy, the plan to move critical supply chains like EV batteries away from geopolitical rivals and to allied nations. What really brought this to a head was the realization that unforeseen domestic issues like labour shortages and immigration enforcement can severely delay or increase the cost of these vital projects. We're already seeing signs of this in the economic data. For instance, manufacturing employment recently saw an unexpected decline, and spending on new manufacturing construction has also dropped. This raid reveals a major vulnerability in the US. Building the factories is one thing, but finding the people to build and run them is another challenge entirely. And here's where it gets interesting, especially for China's position in the global market. Disruptions like this at the Hyundai LG battery plant could paradoxically strengthen China's dominance in the EV supply chain. Right now, China controls about 70% of the global EV battery market. The US is trying to build its own non-Chinese battery production capacity. But if these projects get delayed by labour issues or policy friction, it just gives China more time to extend its lead. This is a classic example of how uncoordinated domestic policies can accidentally undermine broader geopolitical and industrial goals. If that was just the appetizer, the main course is just being served. While scrambling to manage this public relations nightmare, Hyundai just revised its entire financial forecast. The company is actually increasing its revenue projections, now expecting growth between 5% and 6%. But believe it or not, it's simultaneously cutting its operating profit margin targets, citing headwinds from US tariffs. The reason for this apparent contradiction comes down to a concept called margin compression. Even though Hyundai expects to sell more cars, which increases revenue, the costs associated with tariffs are eating into its profits. The company is finding it can't fully pass these extra costs onto consumers without hurting demand. This is a signal that automakers' pricing power might be peaking, and it could mean wider profit margin problems for any industry facing similar protectionist policies. This all begs the question of what investors are supposed to believe. The situation presents a fascinating duality. On one side, Hyundai is reconfirming ambitious plans to boost global sales by 34% to 5.55 million units by 2030. On the other, its brand new American factory is the site of a historic federal raid, and its profitability is under pressure. With its new CEO taking the stage in New York, Hyundai is now fighting a high-stakes battle on two fronts, navigating a diplomatic and operational crisis in the US, while simultaneously trying to convince Wall Street its ambitious global growth plan is still on track. This brings us to a crucial point for all global investors. The timing of this raid during Hyundai's big investor day shows a growing disconnect between corporate expansion plans and unexpected sovereign risks, even in developed markets like the United States. It forces investors to reevaluate the political risk premiums for foreign direct investment. For years, the US was seen as a perfectly stable place to invest, but sudden policy shifts and enforcement actions are changing that calculation. So for anyone tracking global markets, what are the key indicators to watch? First, keep an eye on those US labour reports, specifically the JOLTS data for construction and manufacturing job openings. If they remain stubbornly high, it signals the labour bottleneck isn't going away. Second, watch construction spending reports to see if investment in new factories continues to slow down. Finally, any further immigration enforcement actions at major industrial sites will be a critical signpost for how this trend is developing. These indicators will give us a better sense of whether the US can overcome these hurdles to successfully reshore its critical supply chains.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.